Welcome everyone to this week's edition of Navigating the Markets with me, Markets and Mayhem, coming to you live Monday, August 26th, 2024. First, let's quickly get through this risk disclosure. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. We had a choppy trading session today with the path of least resistance being lower, led by technology companies. We can see the red really focused in the semiconductors here as well. We also saw some red in some of the consumer cyclicals, a lot of green in other areas. Though we saw strength in defensives, energy, basic materials, utilities, some green within financials as well. So there is a bit of a rotational dynamic to this price action, and that is constructive, and it will be something we talk about in some of the other subsequent charts. But ultimately, what we really want to do here is have a look and see if there's some continuity to this rotation as we go throughout the week. Tomorrow we'll have consumer sentiment, Wednesday NVIDIA earnings, Thursday we'll have GDP, and then Friday we have PCE. So there are some event volatility catalysts that could kind of lead the way in terms of what we may expect to set off some of these rotations should they continue. And NVIDIA earnings are a big one for that. For example, if they come in a little bit disappointing, I would expect money to kind of get out of the AI story stocks, the semis, the SaaS companies that are more peripheral to that, especially in the LLM space, and move more into some of these areas of the market where we're seeing some relative strength. So that's something to keep an eye on. It also may be a good way for us to kind of manage risk in this environment, because there's a lot of risk concentrated in big tech, but we're seeing some expansion into the equal weight and value parts of the market, which we'll get into in a bit. But first, let's just dive into today's overall book map chart. This is going back to pre-market, and we could see really at 9:30 a.m. we had a nice pop, and then it was just really selling pressure from there. The opening range was defined around 950, and we could see that we really broke down below that opening range and just had continuity lower from there. So that's something to keep an eye on. You know, when you see these types of breakdowns and then you start to see other flow that supports it, it's more than likely going to be a trading day that has a trend, right? So we broke down below the 20-minute opening range. We continued to move lower. There was some degree of aggression by sellers. Options flow became more bearish as the morning went on, and we could see that did lead us to lows. Ultimately, we sort of found our low just around 2 p.m. or shortly thereafter, and that was just above the most active put strike on SPX, which is not likely a coincidence. That was where, near dated options buyers were looking for the end of this move, and indeed it did cap out about there. It was also not a very liquid trading session today. Liquidity has been dropping once again, and we can see that as both the bid-ask spread widens and the total order book liquidity drops. And it traded somewhere between about 42 and 48,000 today. I really like to see it above 50,000 and ideally above 60,000. And we can see when we go back to July, there was much better order book depth. So we're just not quite in a liquid environment, which means smaller size, wider stops, and being really careful about selecting trades, because, as you saw in today's intraday price action, it was a pretty dynamic, pretty volatile trading day. And in that sense, it means that it's a good time to be tactically cautious. So if you didn't catch the breakdown in the opening range, there were some opportunities to reoffer when we tested some of these key pivots. And we'll look at that in a future chart here. But at the end of the day, you've got to be careful with the rate at which you're trading in this environment, because this is one that can be a little bit more unforgiving. So let's look at the options complex here. SPX 5600 is a key level for us to watch. We're hovering just above it here. And I think that that's important, because this is an area where if we do break below it, we've got an easy 50 handles lower before the next options implied support level comes into view. So above us, we can see there is some potential resistance around 5650 derived by SPX full chains options positioning in that delta on the call side. And below us, 5550 has a decent amount of put and call exposure, and that could be a reasonably strong area of support, as could 5500. Below that, Obviously not so much, but positioning tends to roll with price. So we'll keep an eye on these levels. They get dynamically translated throughout the day. So we rebalance these every night. They are shown in the hot levels as well as bookmap, the SPX and ES commands. So you'll see them in any of those commands as we translate between SPX and ES levels. We're also in positive gamma territory here. So that also gives you a sense, we're in there by about, 50 points. That gives you a sense that we do have a dynamic where rips are more likely to be sold into, dips are more likely to be bought by market maker hedging dynamics. And that's something to keep in mind if you're trading this market, just to know that volatility may not be quite as elevated as we've seen in weeks prior as we push deeper into that positive gamma territory. The other side of that balance, however, is that it is still somewhat illiquid on the order book, and that can improve or increase realized volatility intraday. But just be careful about too much of the aggression on the dips or the rips, because you've got market makers kind of counterbalancing that as they're rehedging those positioning. And we could see that today too. We saw some decent dip buys and rip sells intraday as well. So let's get into the pivots here on the ES contract and talk about really what I'm looking at going into tomorrow. So above 38.50 or 56.38.50, I am looking for intraday longs, especially if we have an opening range breakout on the 20-minute time frame to the upside. And we have options flow that is prevalent on the bullish side. Those are the two preconditions I have, but I like to have the pivots there as sort of a line in the sand based on volume profile to have a sense as to what the broader market was thinking in previous auctions. On the same side of that, looking bearishly, 28.25 below that, and I'm looking to fade this right back down to what'll be SPX 5600 and ES about 57 or 56.1725. So I think we do still have a somewhat two-sided market, but I will say it looks heavy. It does look like it has some room to roll over, but the one cautious note I'll put ahead is that Tuesday is statistically the most bullish day of the week, so you don't necessarily want to fight that too much. But if we do move below that 28.25 level into tomorrow, close below that opening range and see, bearish put flow prevail, we could have another bearish trend day tomorrow. So that's something to keep in mind as we get into the trading day. Just got to put all our, biases aside for a minute if we're trading intraday action and really look at what's going on in these charts, in the flows, and see what the setup is from the opening range. Now, looking at the NASDAQ, I just started adding pivots to this one as well. So I'm bullish above 19,671.75 and bearish below 19,593.75 with a similar set of preconditions. I do want to see the leading NASDAQ stocks showing some strength, the NVIDIAs, Metas, Microsofts, and an opening range breakout to the upside if I'm going to be bullish above 671.75 and similar below 593.75. I want to see the really at least 5 out of the 7 Mag 7 showing some relative weakness and a downward trending day as defined by an opening range 20-minute breakdown with some acceptance. So, I look at convergence. That's one of the biggest ways that I trade. I like to have multiple data points that give me a sense that I'm on the right track with my trade. And so, the opening range is part of it. It's a big part of it. But then I do want to see some of these other convergences to gain some more confidence behind that trade. So I'm pretty selective, especially in a low liquidity environment. Another thing that has me just a little bit cautious near term is that exhaustive reading on the New York Stock Exchange that I mentioned over the weekend. It is persisting. It's come down just a little bit, but it's still 83, just above 83 at 83.88. That's quite high. This is really around the top of the range. Typically, when the market gets this elevated, we see a pullback in the near to intermediate term. And so that's something to just be aware of, especially as we're coming up against NVIDIA earnings and some bigger macro data points, that there is some signs, not everywhere. It's not, universal, but there are growing signs of, I would say, bullish extremes. This is one, AA sentiment that I covered in my market update last week after it came out on Thursday. That's another one where retail bulls are outnumbering bears by more than 2 to 1. I think that we as a market participant contingency, the retail folks, are getting a little bit too bullish here in the near term. Doesn't mean we can't have a continuation of the uptrend, but it does mean that, over the next several days to a week, we may get some consolidation or a pullback before that sort of trend can continue. And we have to go through these major events like NVIDIA earnings and GDP and PCE and otherwise to really see how the market reacts. We also have about $183 billion of Treasury auctions going this week, with 2s tomorrow, 5s on Wednesday, and 7s on Thursday. That's also going to be somewhat important to get a sense as to whether other auction participants are on board with this idea that there's this aggressive pricing of the Fed's cutting cycle, which, Fed speakers have more or less pushed back on, except for Powell, who didn't directly address it, but sort of indirectly address it by making it more, I would say, dependent on the outcome of the labor market as to what the pace of cutting may be. He didn't necessarily word it specifically, but remember, going into September, we get their SEP report. That includes the dot plot. Part of me thinks that Powell didn't specifically address that point because he wants the other members to feel like they have a voice here too, so that they can collectively put out that dot plot, and then he can speak to what the consensus is at the Fed with some more data behind them and a little more certainty as to what the cutting cycle looks like. But nevertheless, I'm not on board with 50 bips for September. I'm not on board with 100 bips for 2024. I came into this year looking at expectations for 7 cuts this year. I said at best we get 2 or 3. Now I'm down to 2. So I really think it's 50 versus 100 bips this year. And the market's looking for 200 bips going into July of 2025. I also think that's a little bit too aggressive. The only thing that makes those, I would say, more aggressive scenarios possible is the bottom falling out in the market and or economy, which doesn't look like it's right ahead of us. So that's just, something to contextualize, because it sets up some trade opportunities to fade the short end of the yield curve, particularly if we get some weaker auctions, but also to look at SOFR futures out to, say, July, September of 2025 with the same idea of fading them. Now, we can see not only is there some exhaustion in the New York Stock Exchange number of issues above the 20-day moving average, there's also an expansion of breadth, which is a good thing. The near-term reading of this big of a number of new highs versus new lows at 538 may also be somewhat exhaustive. We can see the last time we saw something like this in July, there was a near-term pullback. So it's a good sign in the big picture over the longer term that we're seeing this sort of breadth thrust higher, and more of the market is participating. And it's not the tech stocks. The NASDAQ mid caps and the NASDAQ large caps are struggling more than what we're seeing in the New York Stock Exchange, which is a broad composite of equities. So this is another really important thing to take into consideration. You are seeing the rotation. You are seeing this shift into a broader swath of stocks as Mag 7 earnings and revenue growth slow, and the S&P Inglorious 493 are seeing an improvement in revenue and earnings growth. Another area that's important to watch is the dollar. I know we've all had our eyes on it more or less, that and 10-year rates. I think we're getting closer to a bottom. This aligns to a level we saw late last year. About 100.5 on the US dollar index is a key level I'd watch really close here, just like around 3.8 on the 10-year. I think these are two really important levels to watch, because right now, rates have been leading the dollar lower, but they both appear to be basing around current levels. And if that is true, then we could get some trade setups, long dollar, fading euro, even fading some of the recent moves in the yen, maybe fading the 10-year contract or some of the proxies like IEF. If we start to see that reversal, this could set up some decent macro swing or pair trades that could be worth exploring. But for now, we've got to watch, because on the other side of it, obviously, if the dollar breaks below this level, long euro, long gold, all those trades start to look even better. Same with going long, say, IEF or TLT into that type of a move. So I'd say right now we're at an inflection point. The correlation between the dollar and the 10-year note is very high. So they're likely to continue to move in tandem. And I'd like to keep an eye on this one, because I think it'll determine what some of the other trade setups look like that are, more directed by dollar and rates. Speaking of which, one of those trades is gold. Gold has been showing really impressive relative strength versus the broader commodity index. And this has given me a sense that gold does have room higher. Even if rates in the dollar bottom, I think that gold is driven by this trifecta trade. It's the central bank cutting cycle. It's the growing certainty of a slowing global economy, which tends to be good for gold. And it's also the rising geopolitical tension that just keeps kind of boiling under the surface, both in the Middle East and in Eastern Europe. I think all of this has put a strong bid under gold, which is likely set to make new all-time highs and hit 2,600 in September. That's been my target for months, and then looking into 3,000 for the first half of next year. That all seems to be on track, and this is what I really like about gold here. The top chart here is the Bollinger Band width, and then in the chart, the main chart is a weekly chart of gold. Now, in this circle or in this boxed in area, this is the Bollinger Band squeeze, right? You can see the Bollinger Band width was very low back then. That squeeze is a sort of consolidation period of lower volatility. When you see squeezes like this, particularly momentum-driven commodities like gold or oil, and especially gold, they often precede a large directional move. Adding to that, when gold is above its 50-week moving average, it tends to have the potential for continuation higher on one of these squeeze breakouts. So that's the double, right? I'm looking for the squeeze and the breakout. So you can see now from this period forward, you had this breakout of a trading range, but you also had expansion of Bollinger Bandwidth. That's telling you price is becoming more volatile, but momentum is also starting to get the potential to build significantly. So if we're above that 50-week moving average, and we're seeing that Bollinger band breakout to the upside, that tends to be an area where you can see this continuation. And I know a lot of folks like to look at Bollinger Bands as like resistance or support. I would take a totally different look at them and look at them instead as a measure of the implied volatility of the underlying asset. So moving above this top Bollinger Band here is actually bullish in the context of a Bollinger Band squeeze to breakout type of trade, because what it's telling you is there's increasing upside volatility. And you can see we're continuing to hug that top band even into the current trading environment. So I bring this up to say this is a big reason that I'm still quite bullish of gold here, because we have a continuation. You can see that the Bollinger Bandwidth continues to expand as gold's volatility continues to grow. You can see the trend is going in the right direction. We're well above the 50-day moving average, and we're starting to clear some of these key levels in gold as well. So I'm still pretty optimistic about gold and the higher quality miners from here. And I believe that we've got a path to at least another 10-12% higher over the next 6 months. Now let's look at oil, because oil is showing us a very interesting picture here. We are squeezing. We can see that Bollinger Bands are clenching in now on the price of oil. The price range of oil has been narrowing, and you can see that Bollinger Bandwidth has narrowed as shown by the top chart. So what that tells us is we are getting closer to a point where oil is likely to make a very large directional move. We do not have any certainty as to what that direction may be. So the best thing to do for me as a swing trader is watch and see what it tells us. Let's let the big market participants give us a sense as to what their vote is, because whichever way we break here, whichever way we kind of break above or below the prevalent bands and then see the bandwidth start to increase again, that's likely to be that breakout or breakdown. And if there's some continuation in that, that can be a larger long-term momentum trade with continuation over weeks and months. So there's no rush to get into this. Obviously, with the global economy slowing, there is some risk to the downside in oil, but on the other side, with geopolitical tension rising and some, possibility we could have different areas of oil production knocked out, that could also bring out a pretty big upside squeeze breakout. So we need to wait for the market to tell us where momentum is coming in, and then opportunity will follow. So I'm very patient with these, because you can see this one's been setting up for at this point, it's been setting up for over a year, this squeeze. Right? Wherever it goes with this long of a period of squeezing, it's likely to be pretty big. Here's an example. This is the last time we had a long-term squeeze that lasted over a year. When that finally resolved, oil went down about 90%. Right? So I'm not saying it's going to be the same type of move this time, but that gives you an idea. Here's another smaller squeeze that we had going into 2022, right? Obviously, there were geopolitical catalysts here, but that squeeze led to a pretty significant move from the top of the band to where it ultimately ended. There was at least about 35-40% of a move there. So these are powerful moves, these momentum changes that happen, and Bollinger Bands tend to be a great way to identify them. So consider building a chart with them, whether it's TradingView or stock charts or whatever your favorite platform is. and plot Bollinger Bands weekly. Use a 50 period, look at 2.1 standard deviation, create a subchart or a top chart that shows the bandwidth, and start looking at this in Bitcoin or gold or oil or whatever your favorite momentum driven trading vehicles are. It's easier to use broader kinds of things like asset classes or indices than single stocks. It's going to be more difficult on single stocks or sectors or industries. But if you look at commodities, if you look at cryptocurrencies, if you look at indices, regions, things like that, you can find some pretty awesome trades driven by those Bollinger Band squeeze breakouts. And speaking of trades, here's one that I put on today. This is a beginning of a trade in FSLR. That's First Solar. It is breaking above the 50-day after finding some support at the 20-day. I like starting the dollar cost average into this one over the next week or two to build a full position. I would guard my risk by getting out of it if it's below the 50-day. Otherwise, I would be looking for a retest of $300 with the core. This could also be expressed as a bullish vertical spread, buying the 300 and selling the 320 for the September expiry. So that's one of the swings I'm looking at. And I love the relative strength today because even though it faded from its highs, this thing was showing really good relative strength versus the broader market. You could even maybe make the argument showing some kind of like inverted head and shoulders. But either way, it looks like a reversal to me. And I like this as a long position here. And our DigitalOcean trade as a long swing is doing well. Overall, it's pulling back a little bit today. We'll see how it does with that descending trend line. Now, another area I'm watching is value. Value is outperforming growth again in the large caps. This is important because this is part of that broadening out thesis, and this could once again set up a trade of long IWD, short IWF. But let's see what happens with NVIDIA earnings because that'll be pretty pivotal for this and for this other trade. RSP, or equal weight S&P, is outperforming market cap again. This again could be another trade with legs, especially if NVIDIA comes in sort of at or below expectations and we continue to see this rotational move in the broader market. So these are trades to keep an eye on, thoughts about what's going on in the markets. And now I'm going to shift over to Q&A. And folks, if you have any questions, please drop them in the chat. So I like Agnico Eagle. I like some of the streamers as well, like Wheaton Precious Metals and Sandstorm. And then I have a junior that is a very high risk play that I got in at a cost basis of about 15 cents. And that's Rio, Rio.V on the Toronto exchange, and then Rio FF in the US. But that's one I'd be cautious with because it's already had quite a move. It's almost tripled from those lows. And then there's also always GDX. You know, you could run a bullish vertical spread on GDX as well. But one thing to be considerate of with the miners is this is an industry where habitually they just set money on fire, and that money is our investor capital. And so we have to be like exceedingly cautious screening management if we're getting into single miners or if we're playing the index, which is dominated by garbage, whether it's the seniors or the juniors. It's just underperformed gold for over a decade. I'm not so sure that changes outside of the really good and well-run companies. So I think platinum and palladium have such a different set of drivers that that's going to be a more of a global transportation story. So I think if, we see the global economy start to expand, then platinum and palladium could certainly follow that narrative. But I think what's more likely to follow gold is silver, and silver's industrial demand is starting to come back now that we're seeing some, more initiatives in renewable power, rebuilding of military arsenals, build out of communication equipment, and new battery tech that uses more silver. Some of that industrial demand, that's the sort of other leg of silver, is starting to come back in. So I would say of all the three, of silver, platinum, and palladium, I think silver has the best chance in the near term. But if the global growth story starts to rekindle in this new cycle of rate cuts, if we start to see emerging markets coming back and China starting to strengthen again, then I would say that platinum, palladium, and copper would be really good longs. I think that the big thing with industrial metals right now is just China is such a big consumer of them and their economy is languishing that it's been hard to get too bullish of them with too much conviction. We had that great run in copper. It got absolutely lopsided in every way, positioning, backwardation, premiums between COMEX and Shanghai and London and elsewhere. So we kind of know what to look for when there is euphoria, when to get out. But on the other side of it, now we're kind of in the hangover period. A lot of folks got burned on that. A lot of people got long, $4.85, $5 copper, higher levels of platinum, palladium, miners at higher levels, etc. We were fortunate enough to navigate that with a decent amount of agility and capture some of that beta. But I'd say this time around, it's going to be more of a show me story for market participants, and they're going to be really focused on China. So we'll be keeping an eye, but for now, things are getting kind of more problematic rather than less so in China. And the turnaround story there could take some time. So we'll kind of look at it as a steady as she goes story and look at some of these key levels and demand figures for the metals to get a sense as to where we're going from here. I will say platinum is starting to move back into a constructive bullish trend channel that it has not been in for quite some time. So if it builds into that channel and we start to see some better data coming out for transport demand, that would be good. Today's durables numbers were decent for transports, right? Durables came in at like over 9%. The expectation was like 4.25, 4.5. It was good to see that, but it was also on the heels of a really bad June print, which probably had a lot to do with some of the bad weather we saw as well. So I'm asked, can developing Asian markets and or developed Asian markets do okay without China? Absolutely. Yes. The biggest thing to look at there is what is the trade relationship? Like what are the amount of exports that they're reliant on China, for? Like if they're a country that's so tied up with China that their export demand is really contingent on China taking like 20% more of their total exports, and they're an export driven country, that's going to be an issue. But look at Japan. Like remember in 2023, my trade was long Japan, short China. And it was on the basis of improving economics and market conditions in Japan and deteriorating economics and market conditions in China. And it was a trade that, even though we had a really good year in the US markets, it exceeded those gains, and it had everything to do with those divergent outcomes. And the reason I mention that is, you can certainly have developed or developing Asian markets do well without China. Look at the Philippines right now, for example. Look at Malaysia right now, for example. There are some pockets of strength depending on how interconnected these economies are with China. And some of them are doing better. The ones that have less direct connectivity, they're really able to stimulate internal growth, that are getting into their new rate cutting cycle. They're starting to outperform. You just have to really be picky. And if you're not going to look at the macro too closely, there's another shortcut you can do. You can do a relative strength chart. So like look at an ETF of a region and compare it to the Vanguard Global Fund, the VTI, right? See if that region is showing relative strength on a weekly and monthly basis, and even quarterly basis. If it is, you're seeing a broader institutional rotation into that part of the world's markets. And that can be another way to get a sense as to, is this something that looks better than the baseline? Is this something that looks better than China? And you can also drill down and be a little more specific, like take an emerging market stock or emerging market index, compare it to the broader emerging market index, right? So if you're comparing like Malaysia to the broader emerging markets, you'll see that relative strength as well. So if you can contextualize that there's outperformance there, and maybe there's a macro narrative that also supports it, that sets up a nice swing trade for me on that basis. Korea, I may be a little more cautious of here because the semiconductor story there is starting to show some signs of getting a little overheated. It's around this time in the cycle that semiconductor companies get a little too confident, like the memory sellers, and we see this in NAND and DRAM. They're starting to jack up prices. Typically, when they do this, they think they're just going to get all this demand and they're going to have better margins and revenue. But the reality usually ends up being a story of demand destruction. They kind of shoot themselves in the foot. So I would be a little more cautious with Korea just because they're so dependent on semiconductors, and there could be some slowing in the NAND and DRAM space right now. Yeah, so I like Philippines. I like Malaysia. I still like India too, by the way. And Indonesia looks interesting. Yeah, that is one that I've had my eye on. Thoughts on uranium? The world needs more power from wherever it can get it. And so on a secular basis, I'm bullish on all kinds of power sources, whether it's nuclear, solar, wind, gas-fired power plants, even some of the coal technology that's cleaner. I think we're going to need it from any and all sources possible. And so uranium falls into that bucket. And I think the better run companies in the space and the commodity itself are things that we can be bullish of over long time horizons. Now, obviously, if the global economy begins to weaken here, then you have to be a bit cautious because these are cyclical types of themes in terms of like the near term trend. You could have a big correction, but on a much more zoomed out long-term basis, I don't mind accumulating exposure to energy producing and distributing assets like well-run energy companies and well-run utilities in this environment where there's large and increasing demand. Yeah, and I mean, I think we just don't have a choice. We need more power. We've got all these new users of power. Even if it doesn't end up being the AI story, you've got all kinds of other feeds into this. And I think that at the end of the day, we went for decades focusing on power efficiency, and we've kind of hit the law of diminishing returns. We've gotten really efficient, but we've probably kind of hit a wall as to how much more efficient we can get near term. And at the same time, we've got a glowing economy. We've got more people. We've got more countries that need to kind of improve their quality of life. So they're going to need grid power. They're going to need sources of power. I think that we still see power usage continue to move higher from a variety of different inputs. And even though there's been some resistance to nuclear power, if it's done properly and the waste storage is done properly and the safety measures for erecting and protecting the plants from natural disasters are done properly, then we can avoid a lot of the nasty outcomes we've seen. What we saw at Fukushima was because of bad engineering and not taking seriously warnings about exactly what played out. They were warned that that exact scenario could happen, and the company TEPCO, they didn't act on it because they wanted to save money. And we can see that now moving forward, I don't think anyone will be allowed to save money cutting costs on nuclear. So, on the one hand, I think that there's opportunity here, and on the other, I think it's a lot safer than what the world may think of based on the recent memory of some of the bad incidents. Think about how many plants have been running for decades without any incidents. We are going into an era of greater scarcity. And it's greater scarcity of energy, it's greater scarcity of arable farmland, of potable water, and that ends up being related to certain sources of food. We've seen what's happened in cocoa, and some degree of scarcity, structurally speaking, from a labor force, as we get to the other side of this easing cycle and the global economy starts to grow again. And all that portends to, an environment where it's more likely that we have a structurally supportive cycle in commodities for some time to come. So I think we haven't seen the end of the commodity story, which means we probably haven't seen an end of the inflation story. And all the steps that policymakers are making right now actually reinforce that view, because they're cutting into an environment that isn't that weak. And maybe they see something I don't see, but I think that those cuts will boost demand and there's not enough supply to meet it. So we're likely to see a lot of these prices start to come back as we get further into this global cutting cycle. Credit becomes cheaper and people are able to start consuming more, particularly on the good side of things. And that's going to be pretty bullish for energy. It's going to be pretty bullish for agriculture. It's going to be pretty bullish for industrial metals. And this has been a theme I've been talking about since 2022. From an era of abundance, decades of abundance and low inflation and just, more than we could ever want, especially in America, to an era of scarcity. Some of it is natural scarcity. Some of it is artificial scarcity from, poor regulatory policy and from a lack of investment. I mean, we've seen the energy industry really not investing enough in discovery and production for some time. That's been one reason there's been so many mergers and acquisitions. And we can see that in the copper industry. There hasn't been enough exploration. Not enough new mines are being brought online. So, if there is a big rise in demand, particularly in a short time period, like less than 2 years, there's simply not enough capacity. And that definitely brings back some of that inflationary pressure. So one of the things I talked about in that scenario was, we could get central banks cutting too early, which I think you could argue that they are. They're going to do what they're going to do, but they're likely to cut too early. It's likely to bring back some of that stimulative demand side pressure into a lot of real world stuff like commodities. And that's likely to have them not be able to cut as much as they want and actually have to start hiking earlier. But overall, that sort of catalyst of long-term global demand building, you can't really put that genie back in the bottle. particularly when they're so scared of anything that even vaguely resembles deflation for even 5 minutes, and they start panicking and throwing liquidity into everything. So I do think we kind of have this knee-jerk impulse to build demand, and we just don't have enough long-term supply. So yeah, that's a big long-term thesis of mine. It's obviously not what we necessarily want to see, but we are also in this to A, make money, B, try to protect ourselves against inflation, and C, follow that big picture over time, because when macro meets momentum, you see these big opportunities set up. So folks, we'll go ahead and wrap it up here. Appreciate you all coming out, hanging out, and being members of the Trader Aid community. If you have any questions about anything presented tonight as you watch this video or just after you've watched the live, feel free to share them in the Discord questions channel. And, I'm always around if you want to DM and chat about some of the things we're looking at here. But as always, really appreciate you all coming by. Remember, tomorrow 9 a.m. I'll be doing my live stream of Bookmap as well, so y'all are welcome to check that out. That'll be on their YouTube, and I'll be showing more about how I use Bookmap to analyze order flow, to set up trades, a little bit more about how I use the SPX options visualizer, how I look at liquidity, icebergs, and stops. So if you all want to learn more about how I use Bookmap, it's an hour long. You're always welcome to ask questions during it. I encourage you all to hang out. It's a lot of fun. So thanks again, everyone. Hope you all have an awesome rest of your night. I'll catch you tomorrow morning.